Hey, what's going on, YouTube? And welcome back to Tech Conversations. As always, I am your host, Guillermo, and as always, I am not a financial expert nor licensed professional. If you plan on investing in the stock market, please consult with one first and invest at your own risk. So, I hope you're having a great day today. It is November 15th, and it is finally Sunday, which means the stock market will be open tomorrow. Hopefully, we can all see some great gains this week. Let me know in the comment section below if you think tomorrow will be a red day or a green day in the stock market. Now, yesterday I talked about selling put options on Robinhood to generate consistent income every single week. And so in today's video, I want to talk about selling call options to generate income every single week. And so in my opinion, selling call options is one of the safest option trading strategies that is out there. And it just allows you to collect premium and build some slow and steady gains. But again, in my opinion, slow and steady always wins the race. So before I get into selling call options, just a reminder that I will be doing a giveaway here once I reach 20,000 subscribers. It's been an insane journey. Thank you guys so much for your support. If you'd like to enter that giveaway, all you need to do is hit the like button down below. Make sure you're subscribed to this channel and let me know in the comment section below what your favorite stock in the stock market is right now. Let's get into selling call options. As you can see, currently I'm selling 1, 2, 3, 4, 5 call options. And so a couple of things firstly before we get into this. Firstly, you're going to have 100 shares of a stock. Okay, on Robinhood, we're selling covered calls, meaning you have to have 100 shares of that stock that you're going to be selling the call on. Secondly, when it comes to that stock, make sure it's a stock that you would not mind holding those 100 shares of for quite some time. And make sure that it's also a stock with good upward trend, good growth, and lastly, this is more optional, but try to find stocks that pay dividends. Because if you are going to be holding on to 100 shares of a stock for quite some time potentially, then it's just nice to collect some extra money from the dividends while you're holding those shares and selling covered calls. Okay, so one of my favorite stocks for that is Microsoft. Another one of my favorite stocks is Apple. Now, I don't own 100 shares of either of those stocks right now, but I will here very soon. So instead, I'm just going to use one of the stocks I do have 100 shares of, TTCF, Tattooed Chef. Okay, Tattooed Chef is, it used to be FMCI and it just recently merged into Tattooed Chef. Okay, and so as you can see, I have 110 shares of Tattooed Chef, so I have at least 100 shares, so I'm fine with that. In my opinion, in the long term, this will have good upward trend and high growth. It doesn't have dividends right now, but again, that's more optional. But again, I do try to find stocks that do pay out dividends. And so let's go to trade options for TTCF. Let's talk about how selling call options works. So again, we're not buying options, we're going to be the seller. Okay, we're going to sell calls. And so here we are. And when it comes to Tattooed Chef, remember the first thing you want to do is choose your expiration date. I always choose the closest expiration date to me, which is November 20th, which is this Friday. Now remember, some stocks will have weekly options, some stocks will have monthly. SPY has it every other day, right? It just really depends on the stock. So Tattooed Chef has monthly options. So I'm just going to leave it as November 20th. Now, as you can see, I've already have one, right? And you can see that by this, -1 that you see right here. And so as you can see, here's how this is going to work, okay? So we have our strike price. So when it comes to choosing the strike price you want for selling your call, you're going to want to choose a strike price where you're comfortable potentially selling your 100 shares of, okay? And so I chose 22.50 because I'm comfortable selling 100 shares of TTCF at $22.50. I would not be comfortable selling TTCF at $10 a share. So I'm not going to choose that one. Okay, even though it has pretty big premiums, I'm not going to choose that one. Okay, because I'm not comfortable. If TTCF were to somehow skyrocket to $30 and I'd have to sell them at $10, you're going to be losing a lot of money. And so the way this works, okay, is if on this expiration date, so November 20th, let's say November 20th comes, the market day ends. If TTCF at that time is above your strike price, you're going to be forced to sell your 100 shares. So if November 20th came, the market day ended, and TTCF was $23, the share price was $23, then I'd be forced to sell my 100 shares of TTCF at $22.50 a share. And so that's why I mentioned that it's important to choose a strike price where you're comfortable selling your shares. Because if you choose this $10, well, as long as TTCF is above $10 by expiration, you're going to be forced to sell your 100 shares at $10 a share, right? And so, what do you get in return for selling this call option? Well, again, you're going to receive money. You're going to receive a premium, and that's shown under the price. Okay, so if you were to sell this exact same call right now, you'd be getting 13 cents. Now remember, this is going to be per share. Each one of these contracts controls 100 shares. That's why you need to have 100 shares to sell a covered call. And so you're going to receive 13 cents per share or $13 per the contract. So if you sold this call right now, you'd only get $13. Now I sold this call a long time ago, so I actually received $250, and I've pretty much made most of that already, and I'll show you guys that here in a minute. But remember, the way this works is every time that TTCF, well, there's a couple of Greeks here, right, that we need to understand. So we have delta, we have theta, and we have vega. Those are the three most important ones here. So the way this works, the way you're going to make money here is that, delta is going to measure how much the premium changes with a $1 change in the stock, right? So if the share price of TTCF goes up by $1, the premiums on this are going to go up by this times 100. Okay, because again, these are per share, so you got to multiply these by 100. So $9.14. If TTF goes up by $1, the premium on this will go up by $9.14. If TTCF goes down by $1, then this is going to go down by $9.14. And ultimately what that means is that if TTCF goes down by $1, you're going to make $9.14, right? That would be added to your total return. So in other words, this is a bearish strategy. You do want the price to go down. Now you also have time working for you, right? Which is going to be theta. So theta, remember, is how much value this contract loses just from time decay every single day. So in a day, this contract is going to lose $3.88 in premium, which again will be yours. So you're going to be making $3.88 because you're selling this option, and this contract will go down by that much. And then vega is how much this option goes up or down by with a 1% increase or decrease in implied volatility. So if implied volatility goes up by 1% here, then the value of the value of this contract will go up by this times 100. And then it's the opposite, right? If this goes down by 1%, the value of this contract will go down by this times 100. So that's what vega is. So vega again is going to measure the change in implied volatility, 1%. Theta is how much value this is going to lose every single day. Keep in mind, theta does get bigger the closer you get to expiration date. And then again, delta is how much this is going to change with a $1 change in the share price. Of course, remember that you do add gamma to delta after that happens. But that's kind of a quick, brief overview of the Greeks. And so ultimately, right, two things can happen here. On expiration date, either TTCF will be above the strike price or it won't be. Again, if it's above the strike price, you're going to be forced to sell your 100 shares at the strike price. Remember, you always keep the premium though. Right? If you sell this call right now, you're going to get $13. That's yours. You keep it no matter what. Now, if TTCF on November 20th, right, at the end of the market day, if it's below 22.50, then you also keep your 100 shares. And then you can just sell a call for a different period. Right, you can continue to do that. Again, eventually you probably will be forced to sell your 100 shares, at which that point you can continue the whole wheel strategy and start selling puts. Okay, and so again, Since I chose the 2250, I don't think TTCF will be above 2250 by November 20th, which means I'm going to keep my 100 shares, and I'm also going to make $250 from having sold that call. Right, and we can actually take a look here at the option. So here was the call option that I sold on Tattooed Chef at 2250. And so as you can see, my total return now is $237. Right? Because when I originally sold this, I got $250. Right now, it's only worth $13, which means I've made $237. And remember, you don't have to wait until expiration date for to get out of this contract. You can always exit a contract early. So since I sold this call, to exit it, I'd have to do the exact same opposite thing, which would be buy that exact same call. So same expiration date, same strike price. Again, on desktop, Robinhood already has it here for you, right? So I'll just buy to close it since I sold it. If I had bought it, I would have sell to open it. So I would buy to close, and I'd do one contract because that's how many I have, and then I could enter my limit price, which, this says market value is $13. So, I could try 15 and, probably close out of it at $15. And again, I still would have made $235. Okay, so that's how selling call options works. Again, it's important that you're choosing stocks with good upward trend. Again, ideally with dividends to collect some extra money on the side while you're selling your covered calls. And again, guys, the most important thing, make sure you're choosing strike prices that you're not, or that you're comfortable potentially selling your 100 shares of. You have no idea how many people reach out to me telling me that they chose such a low strike price, and now Tattooed or whatever stock is just skyrocketed past that price, and now they have to sell their 100 shares at a loss. Okay, so be careful with that. That's one of the biggest important things to that. So if you guys have any questions about anything that I just talked about, feel free to leave them in the comments section below. I do try to answer most questions. Remember to join the Discord, guys. If any of you plan on using Robinhood in the future, feel free to use my referral link, which is also in the description below. If you sign up using my referral link, both you and I will receive one free stock, which is basically free money for both of us. So let's help each other out, guys. And as always, I hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.